Hi everyone, thank you very much for being here. Thanks for having me today. So yeah, we're going to talk about a topic that I'm personally very excited about, which is AI. So we're going to start with very quick intros. So in no particular order. So Karey is a managing director at Cross Creek Ventures. Then we have Sunil, general partner and founder at Amplify Partners. Greg, managing director and founder at Costanoa Ventures. And then Rudina is managing partner and founder at Glasswing Ventures. So that way we avoided the 5-minute self-referential VC intros, but how great we all are. All right, so the fine folks at Primary suggested we start with a couple of rapid-fire questions. I selected a couple. So the general idea is that they are rapid-fire, so you may answer with a few words or a quick sentence or two. First question, and we'll go this way. What % of the deals do you think you will do in your fund that will be based in New York City, this fund and the next fund?
I think right now, is this on? Okay, it is. I think right now we're 10 to 15% New York, and I think that's probably going to be the same or a little higher going forward.
And we're a Bay Area-based fund. Our investment team is based there. So for us, probably also about 15%, maybe a little bit higher, 15 to 20% for us. And I think on the margin that is going to increase given what we're seeing in New York.
Unfortunately, I can't disagree. We're also based in the Bay Area. Historically, have been 10 to 15%, and I'd say 20% in the subsequent fund.
We are based in Boston, and it's about 40% right now, and I expect it to be about 40 to 50%.
Great. All right, and second question, a little bit of gossip. Name a New York deal you passed on that you now regret.
You know, one that we didn't exactly pass on, but we knew about really early and were very interested in was Datadog, and we had something in the portfolio that we thought was borderline competitive, and so we chose not to engage. And in retrospect, we should have thrown out the one we had and moved on because, you know, they really, you know, the one we had we knew was going nowhere and missed the opportunity to engage with Datadog, which we think is a great company and, you know, on your list of kind of New York unicorns.
Great learning. Always invest in competitive deals.
Dumb luck allowed me to invest in Datadog at the beginning, so rarely do I get to, someone is up here saying I missed that one where I'm not just nodding along being like, oh yeah, I missed that one too. But for me, I think it was a company called 10Gen, and when I met Dwight Merriman when 10Gen was getting started in the back corner of ShopWiki, and it was just a couple guys working on an open source database, and for those who don't know 10Gen is now MongoDB. I was like, this sounds cool, but how many of these developers really want a new database and a database that isn't really a database? Like, come on, guys. So obviously, in hindsight, that was a terrible decision.
So Fred Wilson introduced me to 10Gen as well, and I passed on that, but I'll do another one just to keep the conversation going. So Greenhouse would be for us one that we would love to be an investor in.
And for me, it's Betterment. I met them in Q1 of 2012, and I had, in my old firm, had enough fintech partners that knew too much to actually give it a shot, so we passed.
How about you? What was yours? You're here all the time, so you got a long list.
Ooh. I think about that a lot, actually. But, you know, I've been doing this for like 4.5 years. It's a little early, but I think, you know, maybe VIA is an interesting one. I passed on that one twice, and it felt so unlikely that they would pull it off, but they seem to be pulling it off. You know what I'm talking about, VIA, the shared transportation, which is now evolving into a sort of transportation software company. Ooh, that was close, okay. All right, so I think the danger with AI panels is that for this group of people, we also subject to an avalanche of tweets and blog posts and like everything on AI. So we're going to start at a high level, but I'm hoping that we can get into some real specifics and examples and facts and that type of thing. But to start with the high level, AI, hype versus reality, what's different this time? I think, Karey, you mentioned you started looking at companies, or you've been a public investor you were a public investor for 15 years, now you're a late stage VC. You've seen some companies that were pretending to do or claiming to do AI a long time ago. Where is any of this new from your perspective?
Well, I know there's a whole crop of very new companies that are super exciting. We're not that early stage investors, so we're not as focused on those, but I guess I'm a little bit of a skeptic because I grew up as a public investor and I started in that world, shortly after, Deep Blue was beating the chess masters. And after chess, the next game everybody thought of was public markets, and the computers were going to beat us all at stock pickers and replace us, and that was a long time ago, 30 years ago nearly now. And the reality is computers have taken over a lot of the active managers' jobs, but really it's index funds, which I could have done with VisiCalc on the first computer I ever had. So really in terms of, stock picking and winning that game, programmatic trading obviously is huge, but that's short-term inefficiencies where the computers dominate. Really the long-term management, it didn't happen. So while certainly I think a lot of the new stuff's interesting, I think it's harder than people realize, and I think all the, obviously there's a Zuckerberg versus Musk controversy on ethics and how dangerous is all this, and in the public stock markets, there's been obviously a lot of problems and a lot of circuit breakers that have had to put in, between '87, the flash crash, the night trading, program that went completely rogue and was losing $10 million a minute and nobody could turn it off. There's been a lot of problems too, so I guess I'm a little mixed.
Great. Whoever wants to jump in next.
The title of the panel was, the robots are coming, and that.
Are they?
Yeah. Well, in that dimension, that's clearly, the hype there couldn't be bigger when you start, from my perspective, when you start in an AI thinking about, are the robots coming? The answer is no. Like you're not going to displace a radiologist and say, I want the machine to read my x-ray. The notion of fully autonomous, self-driving, when you actually understand all the practicalities of what it means to put a totally autonomous car on a road, navigating an urban environment with all the variability that comes in, there's so much of a gap between here and there, and stock picking, and is a computer going to figure out what the next drug is that Merck or Roche should bring to market? The answer is no. But when you actually think about using AI as a technique to make humans superhuman in a lot of ways, that is absolutely not hype. We're already seeing it within our portfolio companies where, and we can talk more about this later, is there's a class of software and a class of applications that people are building that the end effect will be an end user is able to do and accomplish things much greater than they could without the benefit of AI powering that application. And we do see those benefits in everything from autonomous operation to financial markets to oil and gas discovery to biomedical research to even like worker productivity. There's a lot going on there, and we definitely believe that there's more coming out of how AI will influence application software than even the changes that came about from the move to cloud or the move to SaaS. It's just going to be more important in terms of what software is.
So I'll take Sunil's side on this one. I mean, I generally agree.
No, you got to disagree.
Yeah, that's coming.
Right,
that's
good.
coming. To me, the question is why, and I actually would argue that the big transformation is the amount and the quality and the cost of sensors everywhere, of the fact that some of those sensors are actually clickstream data that actually matters. So there are orders of magnitude more data. The combination of the cloud and the NoSQL systems for managing the data stack, cloud-based compute to be able to operate on it are actually more monumental changes than the quality of the algorithms. It was those enabling technologies, because you asked why, that basically led to this explosion. And there really is a Cambrian explosion of broadly defined AI that is working in fraud prevention, and it's working in agriculture, and it's working in digital marketing in a whole variety of categories. It is interesting as you think about the trajectory to observe that the leading minds are saying the underlying platforms, the deep learning algorithms are flattening out in terms of their rate of development and of growth. And so it's really their absorption into the business applications and the things we do every day that are the next phase of AI.
So it's interesting, right? Because there is this Nick Bostrom quote that says, you know, if it's a problem that's hard to solve, we call it AI. Otherwise, it's just software. So your question, I think, has a parameter of time that we haven't addressed. I think I agree with some of the answers, but it's also, we're talking about this moment in time. While the hype relates to AI in the broadest and the highest terms, said differently, I think we're in a phase of narrow AI, where it is an augmentation function rather than an automation or replacement function. While a lot of the research and what the media and the hype catches on to is McKinsey predicts number of jobs lost. Yes, and we can have a theoretical and practical conversation around that, but for us as VCs, the practical opportunities, especially as we look at enterprise, robotics, and cybersecurity in my world, are around narrow AI, particularly driving productivity and augmentation. So I think that's an important point not to get lost. The drivers, I wholeheartedly concur, is really connectivity, explosion of data, of techniques, not just on the deep learning and what we have seen as the impetus, but also in reducing the amount of data that you need. So some transfer learning and all sorts of other techniques and correlations that are occurring in the marketplace.
Great, thank you. All right, so let's start jumping into some specifics. So as investors, how do you start segmenting the flow of opportunities into the types of market positioning that you find interesting? So this is the B2B day, so we'll talk about the enterprise, but maybe let's start with AI for consumer applications versus AI for enterprise. Are you more excited about one or the other, and why? And then a second way of thinking about it is horizontal positioning versus vertical. So horizontal being image recognition as a service, speech recognition as a service, tagging, summarizing, and vertical being AI for farming, AI for oil and gas. So consumer enterprise and horizontal versus vertical.
Want to switch up the order to start?
Absolutely, I'll bite the bullet. So I think AI in absolute terms in search of a use case is much like with other technologies, is difficult to commercialize. So from my perspective, we still hold true to end markets and where the pain point is and what can AI as a layer do for me in that regard or do for the vendor in that regard. Because again, I'm of the view that 5 to 10 years from now, us talking about AI, it's like in this day and age talking about having an internet strategy. It's pervasive, and I think that will be the case going forward. But in this moment in time, I'm particularly interested about what it does within the enterprise, both from an IT scaling perspective, HR, so departmentally, a lot of opportunity to incorporate AI as a differentiator for the next gen of what I would say departmental products. I think we see a lot of opportunities around tools, which you refer to as vertical. I think of them more as tools. And there will be some place, in my view, especially as we're seeing around vision in particular, where tool sets, I think of it as software that we've seen for engineering and other areas, so AutoCAD style. We'll see some of those companies scale, but for the most part, I suspect tools will be commoditized. You'll have some players that try to put a ribbon around tools, but again, multi-billion-dollar opportunities, not so sure in that regard. I think on the
what are some examples of tools that you find interesting or think have potential?
Tools I'm actually, for the most part, passing on. The tools that I'm mildly interested in is, machine learning at the edge. So the tools that can get all the open source neural nets or otherwise and put that bow to make them more digestible. I think there's something to be said there. Less interested on the mobile side because Android and Apple increasingly will provide their own tools. Apple has been a bit of, lagging in that regard. But I think tools are less interested. What I find interesting is next gen of IT support. So, I don't know, ServiceNow fans, but what can kill ServiceNow or those services? HR, and again, we're seeing a lot of fragmented HR. Can there be a platform where there is a lot of learning? Knowledge management layer around the enterprise. who wants to input data about what they did? But if you have learning in the background coupled with NLU, with natural language understanding, is there something very interesting and actionable that can be created? I don't mean to dominate, so I'll leave it at that.
Great. Great.
So I'm largely focused on the same thing. I mean, I always care about the implications for the business function, for the business workflow, for the business vertical. And so, because I think the platforms are largely just they're the land of the giants, right? Google TensorFlow being the obvious example, but Google and Facebook and others are investing so much in that startups are not likely to be able to compete. And for me, one of the interesting elements is that so we do a bunch that's vertical and therefore around a very focused business problem. So we've recently done one, not yet announced, which combines computer vision and deep learning for a form of retail automation. We've gone deep and looked at some things in and around insurance and claims processing, which again is a computer vision application that we think is really interesting. One of the things that we tend to focus on is how you bootstrap data and how you build data moats over time. So, we tend to think of sometimes, often people start by aggregating existing data sources. We were just having this conversation. Ultimately, aggregate, curate, and originate. In the long run, you've got to be in the data path. You've got to own the data path in order to have a long-term advantage, because algorithms won't be your protection.
Yep. We'll talk about this.
Okay.
We have 9 companies that we would call being, AI companies, broadly defined, if you kind of thought about what they were, in the ways that most people kind of traditionally describe them. Just to break that down, we have our earliest bet going back to 2013 for us is a horizontal tool company that is not scaling for a lot of the reasons that we kind of have talked about here, creating a horizontal and saying, hey, this as a service, and hey, developer, adopt this and build it into this thing that you're building. It's the business is iterating and taking a lot of different paths versus what we set out, but I think there's a lot that we learned very early on in that bet. We've got 7 other companies that basically look like application software companies to some regard. And they are in verticals like clinical healthcare, in research healthcare, in decision support for intelligence, decision support for retail, in enterprise procurement, and a couple other things I won't belabor, but you could get the sense that they look like a broad swath of application software companies, either organized around a workflow or organized around a specific vertical market application. So that's the meat of what we've done. To be a little bit contrarian, we actually did do our first kind of tools company with an EIR that we had backed, a guy coming out of Berkeley, Dr. Evan Sparks, and Evan and his team actually have had a very clear articulation of a problem that I think a lot of us understood. The problem is, why is NVIDIA's stock price up like as much as it's been up in the last 2 years? And the reason is these applications are incredibly compute intensive. So even if you can collect a lot of data through sensors or whatever, it's incredibly expensive to process lots and lots of data, even with the benefits of parallelization, the cost of these cores, and taking advantage of whether Google or Amazon's going to give you off of their platforms. And we believe that there is a market for optimization there that is only going to grow. So what does it actually look like? How do you actually plan and organize and think about either the algorithm you're building or have built, or the application that you're running, and how that could be optimized? Within a cloud, how that could be optimized, or across different services, how that could be optimized. So they're already approaching people who have, $1 million to $2 million budgets every quarter to run their algorithms and to train their models, and they're looking at them saying, we could cut that bill by 90% by using software techniques that we have. So a little bit contrarian, but I expect that to be the exception, not the rule. It's pretty rare that you find people who have that type of understanding. Most of it feels like vertical and workflow specific stuff.
There's a great quote from Jeff Bezos that AI is going to be the enabling layer that improves every business. And I think as late stage investors, we're very focused on improving businesses, The tools companies aren't to our stage of investment yet, so maybe someday we'll invest in those. But right now we're more focused on the verticals. If you go to an insurance company, a logistics company, I mean, these are IT museums, and we don't need we don't need super cutting edge things to get real competitive advantage in these industries because the incumbents are so archaic. And so we're really focused on either finding companies that sell into a vertical with solutions that can help them differentiate, or companies that actually are in the vertical, they're actually insurance companies or logistics companies that apply the technology to beat the competition.
Great, thank you. So to Greg's point, let's start digging into how you build one of those companies and maybe what you guys want to see in those companies in order to invest in them. So a big thing that everybody talks about is that it's all about the data, and Google and Facebook and all of those companies have an incredible advantage because they have all the data in the world. So how can you, little startup, stand a chance to do this or that when you don't have even a tiny fraction of that data? How do you think about this? What are some of the smart data acquisition strategies that you guys have seen in your companies or elsewhere? And how do you eventually build a business on data?
I'll take a pass at a couple of examples, and then other people can riff on it. I think certainly we're often looking for a tip of the spear application that can get you in that might not be the full-blown thing that you're trying to get done eventually. And so that is the place to collect and gather and start training the models. And at the very early stage, we've seen that be successful. We have also seen cases that we think.
So what's the tip of the spear? It's public data. It's what?
Well, no. So I mean, by the way, you should always aggregate as much public data as available. But I think, like I said, you're always trying to get into the data path. And so in the case of retail automation, for example, you can't take stock photos of everything that's in the store. You actually have to see it in natural conditions, in the lighting environment that exists, in different shading and the like, and you have to do that in real time, which means you have to be in the store, which means you have to convince people to put something in the store even though you're not ready to deliver your full capability. So I think that would be one example. I think demand-based would be another example, which is in business-to-business marketing, where frankly Google and Facebook have all the data, but they don't use it because they're completely focused on business-to-consumer marketing, right? And so if they ever really focused on it, they could potentially do something meaningful, but they don't care because it's 15% of the marketing, of marketing spend, which isn't enough for them to care about. And by the way, the big marketing clouds they're only beginning to focus on it, so they don't really have all the data either, and much of that is easier to aggregate. And then a third example, which is one that we've seen a couple of times, but isn't one that's in our portfolio, is actually doing there was one company that did a couple-year exclusive contract with basically an aggregator of insurance data that gave them the capability to bootstrap and train models. And the question for all of us sitting around the table was, we believed you could train the models on that. The question is, what happens at the end of the contract? Do you have enough that you have fully trained models? Are there other access points to it where a competitor could come in and catch up quickly? Or do you end up with an escalating data advantage over the 7 or 8 or 9 years in which, as an early stage investor, we're likely to own it?
So we have about 24 companies that are leveraging learning and narrow AI in our portfolio, and of those I've seen everything in the book. So, and they range, by the way, because this is an enterprise panel, while we all worry about Google, Amazon, actually more than Google in this day and age, and Apple and the likes, I think they are a little bit less relevant to the enterprise markets on the data side for the reasons that Greg just mentioned. So I think that's an important point to highlight. Secondly, it's also not to be underestimated that the data that we see today and the controls that we see today, as overwhelming as they may be, I think we've just begun to scratch the surface on the amount of data that gets generated. If we believe in connectivity, and if we believe on sort of what's happening under with the sensors and the drivers, what we talked about 5-10 years ago, big data, it looks like a joke. I think we will laugh at ourselves again. So let's not forget what the future paves and whether the incumbents are able to capture the future or not. I hope not, because otherwise this audience would not be in business. And then getting into the concrete paths, I've seen things of the nature, giving the software for free so that you get, so I have a portfolio company called Talla, T-A-L-L-A, Rob May. And what Rob did is basically loaded 2,000 customers of all sizes to get the software out there for free, such that they were contributing, because there's a lot of NLU and NLP involved, they were contributing to the learning. And also, side commentary, but important, the initial data set for learning is the most critical one. The rest, as you feed more data, the impact becomes less and less impactful. It's on the margin at that point. So your initial data set really matters. So we've seen that with customers. We've seen the partnership approach. And then we've increasingly are seeing, again, back to the techniques, it's not just about getting the large enough data sets. It's not just about getting the right data sets, but also minimizing the need, transfer learning and other techniques, for how much data you need. So all of those forces are at play.
Yeah, the only other thing that I would add to that at all is when I think about it very practically from an investment point of view, there is a lot of logic, and I certainly agree with you aggregate a bunch of data, and you get public data sources, and the data builds a moat and the advantage. But one thing that's maybe a little bit unexpected that we've seen in our portfolio, and I continue to see amongst interesting companies, is a lot of companies that are actually very effective at building AI into their products, and to use expand on that Bezos point of view, is it's just going to be part of everything. Is they actually don't start as AI companies. They don't show up with a core value proposition of being predictive or being something. Or something where you're letting the data inform the application more than the application itself is providing value. What they start out as first is, here's a workflow, and isn't this better than the way you're doing something today? And that's the thing that gets a business user or a developer or an engineer going, yeah, you're right, I would love to use this tool. And it stands on its own as a piece of application software. And then as they get the users engaged with the product, and as the users are then providing their own data and are filling out the data set, the ability to start introducing predictive capability into the workflow comes in later. And that's not to say that all companies work that way. I mean, I would love to have something that was much more predictive on insurance that came from thousands of hours of dash cam data, right? But that doesn't mean that you can't sell an insurance software and get into an insurance company first and then turn on the learning capability second.
I'm going to take a slightly different view just to make it interesting. So I actually think if they start without AI and retrofit, I think that's a big mistake, because I think in that case they're truly retrofitting from the get-go. And maybe you were talking about the positioning to the vendor, in which case I would agree. You don't go and say, I'm the AI company and let me scare the heck out of you and the world, we'll take over the world. But from launching the company, if you want to get this right, think about it. What you want to do is build the neural nets and incorporate them from the get-go in your software. So you're training the data and driving the performance from the get-go. If you're going to retrofit, it's a much, much, much harder exercise, and performance will never catch up. And you're doing nothing different than what the last wave of enterprise companies did, right? They innovated around SaaS, a monetization model, cloud computing, and UI, UX. So we had the consumerization. What I believe is fundamentally different about now and this wave, and why performance will be orders of magnitude higher, is because from the get-go, you're building the learning capabilities. And if you are to retrofit, I think you're kind of from the get-go legacy. So I think positioning is different to the vendor. You don't want to scare them.
Yeah, and I think the big difference is what you build and what you sell. Because you have to build that for sure. But I don't know many companies that are going to show up on day zero and say, buy this, it's AI. They're going to say, buy this, it's kick-ass software that helps your company do a thing. And as they get in and they go, oh yeah, this is actually very helpful, you can start to expose those AI capabilities. So I totally agree. If you just start and say, hey, we're a software company and we're going to turn around and decide that we're going to be AI powered 5 years down the road, you're probably screwed. The flip side is, if you walk in and you say, buy this because it's got AI, people are going to look at you and go, what does that actually do for me?
By the way, from a marketing perspective, never walk into a client in insurance or clinical healthcare and say, buy this because it has AI. Yeah. It's really bad marketing. The time for that has already passed.
Yeah.
And I go back to my initial point, which is you
mean
go
the
and
deep
sell
blue
the
effect?
Sorry, so I go back to my initial point. You actually go in and say, I'm solving XYZ problem. And this is why market timing is right and you need me. And the third sentence is, in fact, AI. Enterprises are more and more interested because they don't know how to deal with it. But yes, that's why I said I differentiate between the vendor pitching as a vendor versus what you're actually doing in the background.
What does that mean for the companies in the audience that are totally not AI companies, but want to build AI capabilities along the way? You can be a commerce company, but you want to do some really interesting predictive analytics. How do you bring an AI team in your company?
Me? Okay. So in the interest of full disclosure, I have an AI strategy from the fund, so I actually will not see a company unless they have, even if it's minimal, some level of learning. So that tells you where I sit on the spectrum. But let me take your question from how do you integrate AI, even if they're an AI company from the get-go, because, we talk about business matrix, but the touchy-feely culture and people can make or break execution. And it's a fascinating dynamic we're seeing because you no longer have just the dev people and the technical founder and the product people. You have this third leg of the stool, the data scientists, oftentimes a little bit older, especially if you have younger founders, and oftentimes, they research or teach because they can't do, to use a quote. So how do you get them in a mindset of execution and time is not your friend? That, I think, we're seeing different companies experiment around, and I can't tell you that I've seen the right formula just yet. There is a push and pull. It also manifests itself in who drives. I think developers are still driving, and the visionary is the technical founder is still driving. But depending on the dynamics, the chief data scientist is taking more and more. Sometimes the chief data scientist and the CTO merge in one person. So we're seeing the power shift of product-driven companies challenged a bit.
So
and just one bit, and then we'll open to Q&As.
Yeah. So the thing that I'd say is, one, if you're an e-commerce company, you shouldn't even think about AI. What you should do is license package software, because there are 30 companies that want to do the personalization using all of this data and the like, and people have been doing it for a decade, and it would be ridiculous to go try to do it. But I think in the land of application software, where a great many of us work, it is the case that I think it starts out with figuring out, doing an audit of what data you have and how useful it is and what could potentially come of it. I think the second is, what data could you be potentially collecting that you're not collecting today? And then I think the challenge will be trying to come up with a way of adding the first person. And we spend a lot of time on this in almost every function. Figuring out how to add the first person in a function when you're not an expert and you don't have a Pied Piper to go and hire is incredibly hard, particularly at a time where in AI and machine learning and anything that, data science and anything that looks like it, the salaries for the best of the best at Amazon, Google, Uber, Facebook are through the roof. But you have to start somewhere. And so I think by the time you do that and you hire a really good first level person, you may over time need to up level, but you won't get the star of the industry to come in and turn on your AI strategy unless you have unique data. Because I think, just like great developers want to work on really hard technical problems. I mean, my brother and sister-in-law both run data science teams at Uber and Coursera, respectively. And they literally look for a job by looking for where the great data is. And if you have great data, you'll attract better data scientists and machine learning experts.
Very interesting. All right, shall we open to Q&A? Question here.
Hey, so I'm obviously run a data-driven company in the compliance space, and one of the things that we are always looking for answers to is, as we incorporate black boxes into our product, which is inherently not a black box today, if you saw the demo, we have to explain that to people who are regulated. So somebody's going to have to explain that to a regulator at some point. Like, some of the decision I can understand, some of the decision that got made about why to onboard a customer or whatever cannot be explained or understood. I know there's a lot of research into how to explain things, black boxes, to other people and to regulators. Have you all seen good examples of that being done well? Do you feel like that's emerging, will never happen? I'd just love to hear perspectives on that.
I'll just make a really short statement on it, which is I think the industry isn't very well evolved on it. It's a critically important problem, and you're among the first batch of people that are really going through to do that. You know, we were talking at our partners meeting the other day about whether there's an ability to do that, you know, basically build a platform and tooling company that allows for that kind of modularization so you can see the effect of different types of decisioning. We concluded we think there probably isn't, and therefore it needs to be done in a vertical stack. But I don't think the industry has seen a bunch of those yet, so you know, that just means that you're one of the pioneers.
I think
Good luck.
the delta between automation and augmentation. So while what makes the machine learning and data scientist people on your team is, look, hands off, go for it. From a sales positioning and go-to-market perspective, don't automate it all, sort of get them in the water and then increase the temperature type of thing. We've seen that work a little bit better, which is they don't feel like control is being taken away from them. You know, don't give them a full black box, let them still have some manual stuff, and then in the next release and the next release automate.
Great, thank you. There's another one over there.
How do you think about pricing the technical risk that you guys are taking?
In terms of investment?
Your question is, how do we think about pricing the technical risk as it relates to?
Valuation, risk reward, you know, it's a pretty hype cycle, right? So are there limits on what you're willing to pay or ownership thresholds you solve for to kind of make sure that?
And also perhaps what do you expect to see as well in terms of stage of development for an A, for a B in an AI company? Is that part of the question?
Pulling back from the AI perspective just to the broader, how are we thinking about these things, I assume is your question, or are you asking specifically about in this space and around these kinds of companies?
In this space.
Yeah. You know, for a lot of it for us, again, it doesn't feel very different than how we look at other application software businesses, you know, to the point, again, of it being a foundational technology in some ways more than a category in and of itself. The rare exception that we've seen, and I think we've come up short in pricing in one case and been burned by it, and because it turned into be a great company, it was on the premium for talent. So that example is what's felt different is in some cases at the early stage where you've had a real serious collection of talent. In this case, it was a guy named Chris Ray, who had a MacArthur Genius Grant from, you know, winner, and he was at Stanford, and he was, you know, partnered up with another leading professor out of Michigan, and they assembled 20 of the best minds in their corner of the world in deep learning within, you know, 18 months, and basically got a talent acquisition from Apple for $200 million. I did not price that risk appropriately when I said no to their request for 25 pre. 18 months earlier. And we have done different things since then on teams that we think are truly exceptional and foundational. But if you're not in that category, I don't think slapping an AI sticker on the front of a company is going to change valuation at this point in the hype cycle. I think the time for that is kind of past.
Any more? Do we have a... Yes?
Well, just one other thing in terms of the way we think about pricing and risk. There's definitely technical risk, which, you know, is there, but acceptance risk has been an issue, which, you know, sort of pertains to the prior question, that there's areas where AI technically wins, but users haven't accepted. I think medical is a good example. There's been some great diagnostics that can, for example, predict how aggressive a cancer might be. But if physicians can't explain why, if it's a black box, they're really reticent to say the test just says so. I think in ad tech, you know, a lot of the people that, you know, some of the robots are much better at placing ads, but the marketing people want to understand why we're putting it on that website. And so I think there's also just an adoption and acceptance risk around the black box.
Yeah, I'll throw one more at you guys related to that, which is, you know, we see a lot of stuff where the positioning of the business that the entrepreneur wants to have at the seed stage. It's like, hey, you have 600 people doing this thing, and I can turn it into 7. Which seems like, even if it works, that's such an impossible sale to make. Like, hi, fire 593 people. How are you seeing companies kind of wrestle with that, and are there ways that you've seen successfully to kind of leg into the replacement of humans?
If I could comment on that one, I mean, it's all about who you're selling to. I mean, I think one of the issues for the ad tech folks is they're selling to the agency who's being replaced. If you could sell the P&G, you know, who's replacing the agency, but you know, it's hard to tell the head of that department that we're going to replace you. So that's a big issue.
You know, I think the other thing is, you know, want to always be sensitive to that fact because there are human beings on the other side of that equation. And second, about augmentation. I mean, you never go from 600 to 7 immediately, and therefore it's augmentation first. And that has some implications, but not as severe implications. And so, you know, I think that is actually the path down that road.
And divorcing it from AI, I think value props that pitch to the reduction of costs, whether it's people or otherwise, I think they're hard businesses to sustain through the ups and downs of a cycle. I think productivity and revenue driving a lot better. So that's something when I'm pitched the cost reduction, I cringe a bit.
Yeah, I think in investors and customers alike, they're not interested in hearing a story that starts with, I can save you this much. Most of them are going to take that risk and move forward on a crazy new startup and a speculative technology and all the, you know, and all the risk that comes with it. If you're actually going to talk to them about giving them a capability they don't have or improving their business in some way, just wringing dollars out, we've got plenty of scars to show that that's not effective in most cases.
All right, great job, you guys. Please join me in thanking our speakers.